Welcome to TMS Insights, the November edition. Jeremy Hook and Ben Clark bringing you some updates on what's been going on in a busy market. Ben, October ended up as a good month, but November challenging yet again.
Yeah, certainly, and it's without wanting to, I think, sound like broken records, it's really been those blue chip, high income paying stocks that have pulled our market down. It's a bit of a quandary, the market at the moment, because a lot of the good quality growth businesses, lower income paying businesses, are trading very strong at the moment.
Yeah.
And then you've got the banks, the Telstras, the property trusts, and some infrastructure stocks have come off quite sharply.
Yeah.
And that, I think, makes the headline number look a lot worse than clients' portfolios are actually saying it is.
Yeah. And then that's probably the really good point, because we're not positioned only in those top 10 or 20 stocks.
Yep.
Obviously, stocks outside that, there's some very good stories going on.
Yep.
There's some good growth in earnings, good share price growth. They're obviously not the big attention stocks that get the nightly news, though.
Right, and also I think, highlights why, and a common question we get is, why buy a stock that's only paying a 1 or 1.5% dividend yield? But when you look at where those share prices are trading of a number of those companies at the moment, it sort of highlights why you need to look at a combination of growth and income. Income isn't everything, and what we've seen is that the income area of the market has sort of been sold off across the board. So there is actual potential risk of capital loss, but if you're solely focused on that one area of the market. So it's, for all clients, I think it's good to have a mixed sort of bag of those kind of stocks.
And that's why we will talk more about earnings growth, because that delivers both share price movement, but also the dividend growth of the future, which is really important.
Yep.
So that tends to be our focus. It's important. It's also our clients' focus.
Definitely.
One of the areas in the market at the moment that's been a real focus we have to talk about, Ben, is BHP Billiton.
Yes.
It's been under a lot of pressure. It's down by about a third for the calendar year. It's obviously well off all-time highs and is plumbing, multi-decade lows, really. So, I mean, it's obviously one that people are asking about. Yeah,
and look, I think that the recent movement has a lot to do with this Brazilian disaster that has occurred. The CEO of BHP only managed to get to the site yesterday, I believe, and it's sort of becoming obvious that this is quite a major incident that has occurred for the business, and that's why in the last week BHP has significantly underperformed Rio. It's fallen about sort of 15% versus Rio sort of pretty much holding its own. It's hard to sort of quantify what this means. The longer term issues, of course, oil's at $42, iron ore's at $47. Copper just went through a 10-year low, and they're the three major commodities that BHP produces. They're the lowest cost producer, BHP, of all, close to all three of those commodities, but they've got no control over the pricing. But I would have to say that, certainly I think BHP is a hold at these levels, and it wouldn't take a lot for that share price to start rising, I don't think, because the sentiment's feels about as negative as it potentially could be.
When you're getting those headlines hit the front page and they're negative, it's always a time to be looking at it and seeing how empty is the glass for those people who can't see the upside over the longer term. But it's certainly been a big factor and has had an influence on the market. At this time of year, another big factor is the AGM season. So a lot of companies give trading updates during their annual general meetings, and we keep a really close eye on those because they can be quite an important share price catalyst in the short term, Ben. And there's been some good ones and some not so good ones in the current AGM season.
Which I think reflects the patchy overall market we're seeing. There's some pockets of growth out there. There's some businesses that are doing really nicely, and there's a lot that are probably more Australian sort of focus that are struggling a little bit more. But I've been pretty encouraged by some of the trading updates.
Right. I mean, this week Flight Centre, that was a good one.
Flight Centre was good.
Solid.
The results, sort of in line, or trading update in line with expectations. So the key with this business is the international businesses are all hitting a scale now where they're becoming a much more meaningful profit contributor to the overall company. Valuation looks pretty reasonable. Dividend yield good. Plenty of cash on the balance sheet. Still a good hold, I think.
Yeah, and again, a business, like you said, it's a lot broader than I think a lot of people realise. One that wasn't so good was Sims Group.
That was shocking.
One we don't own, but it's just
I think it sold down
at it
18%
recently, but
yesterday.
we avoided it. It was down a long way. Troubles that weren't necessarily foreseen in their international business.
Yeah, well, look, I think this was embraced as a real sort of turnaround sort of story, and a new CEO with a clear strategy. A lot of instos really like the stock, but it comes back, I think, to the fact that they're selling scrap metal with an iron ore price at $47. It's got to be a pretty hard sort of hard industry to operate in.
A really good business that again had some good AGM guidance was Ramsay Health, and again, it's often seen quite expensive, but it's a premium stock in a attractive sector, and it's very much a stock, like you mentioned, Ben, one of those lower yielding looking stocks that's doing the right things.
Yeah, 12 to 14% earnings growth is the guidance from the company. The excitement recently has been this press talk that they are looking at rolling out into China, which of course could be a huge thing for them. It's not going to happen overnight, but they do seem to be taking steps in that direction, and that might be sort of what warrants the higher PE. But it's a business that is pretty consistent, isn't it?
Yeah, absolutely. We've spoken before about REA, real estate, and its AGM had some good news, and it's also been busy actually making that bid for iProperty in the last month.
Yeah, and so that they gave their first quarterly sales numbers, revenue up 23%, earnings up 30%. They've said that Realtor, which is the US business they recently bought with News Corp in the US, has become the clear number 2. The bid for IPP gives it a Asia sort of leap, and prices on REA's website will go up in March 2016 at a time when there is more supply hitting the boards,
which is already the case now.
The case. So still, I reckon, looks really good.
And it's been a good performer in this period. Another stock looks low on yield. It's got a strong balance sheet, even with the acquisition of iProperty. And again, another high quality growth business. We've had numbers from Wesfarmers just to talk about. They're still looking good. Again, they've been caught up in a bit of the scare about Woolies, and Woolies obviously were disastrously worrying about their current guidance for this next period. Yeah,
look, I mean, Woolworths is a very tricky one, because I think the market sees that the business could be worth a lot more with a management team that is managing those assets better than has been the case. But we still don't have a new CEO, and we still don't have a strategy in terms of what this new CEO is going to do with the company going forward. And in the absence of those decisions, the group continues to deteriorate. I think the numbers clearly show. But you can't help but think that this might be the new chairman clearing the decks for a new CEO to come in and be able to give them fresh air, enunciate the policy. You've got the bad news out there, but it's flowed through to Wesfarmers in that there is this concern that there's a full-scale price war heating up amongst the supermarkets.
Yeah, no, that's right. That's going to be a busy one to watch over the next little while. Again, still a little unknown there. But over this next little period, Ben, as we go through more of the AGM season and we come into December, it's also a window where we see a bit of M&A activity, a few IPOs coming on just before that Christmas period. Anything that catches your eye in that lot?
Well, look, one we've been looking at pretty hard is Seek is spinning off a business called IDP. And we're familiar with this business because it's been part of the Seek group, and we hear Andrew Bassett talking about it, on earnings calls. It's probably one of the best education businesses, and we've been trying to find a good education business to invest in, because I think this will be a growth area. The issue has been that there's a lot of low quality companies in the area. They've got into a lot
poorly managed, structurally not set up right.
But this business specialises in running English language courses for students that come to study in Australia, and it's also doing that now overseas. And it also has a placements business that then places those students into a degree and gets paid a fee. And what I like about it, Jeremy, generally we try and avoid floats, but in this case, Seek is selling it, who is a very good operator, because it's become a non-core asset for them. But the other shareholder that will remain are 38 universities in Australia who will still own 50% of the business. And so you've got, there's good sort of, that the shareholders' interests are aligned with the company's interests. And we were in discussions with Seek. I don't think we're going to be able to get stock in the float, but certainly it could be one to look at when it starts trading on the market.
No, that's a good one. Well, that's all we've got time for in this November edition. We'll be back next month with more updates on the market.